What if I told you that the smartest real estate investors in the world look at the property tax bill every year, smile, and then use a perfectly legal trick to effectively wipe that cost right off the balance sheet? Cool, isn't it? When Hillary Clinton brought this up against Donald Trump in every campaign, every speech, every meeting, what did Trump do? That's right, he just smiled it off. In fact, he still boasts about it today. That guy pays $750 in taxes every year. Don't you want to just pay $750 in taxes every year? I wish I only paid $750 every year in taxes and that's it. Most people look at property taxes as an unavoidable punishment for owning a home. It's a bill that arrives in the mail like clockwork. It goes up almost every single year. Up we go, that way. And if you don't pay it, the government can literally take out your house. But multi-millionaire investors look at the exact same tax code and see something else entirely. They see a massive financial cheat code. I call them the phantom deductions. Today, I'm going to show you exactly how real estate investors don't just pay their property taxes. They use their investments to cancel them out along with a massive chunk of their regular income taxes. And no, we are not talking about shady offshore accounts, weird corporate shell games, or risky, stressful audits from the IRS. No, we don't do that. We are talking about explicitly beautiful written rules inside the tax code that are designed to reward people who own real estate, just like you and me, my investor friends. In fact, thanks to some massive updates in the tax laws recently, including the absolute return of the 100% bonus depreciation rule under the One Big Beautiful Bill Act, the tax benefits for everyday investors have never been higher. If you stick around till the end of the video, I'm going to break down a specific three-step loop that allows you to buy a property, use a phantom expense to erase all your tax liabilities and keep every single dollar of rent completely tax-free. Remember the keyword, the phantom expense. But before we get into the advanced loopholes, we have to address the giant lie you've been told about what property taxes actually are. Because once you understand the lie, the truth will make you incredibly wealthy. Hey everyone, if you don't know me or are new to my channel, my name is Vikram Chopra. I was an investment banker turned broker in the greater Charlotte metropolitan area, where I invest and assist other investors reach their financial goals through real estate investing. Section 1, the invisible scale. When you buy a house to live in, your primary residence, every single dollar you spend on property taxes is money down the drain. You, my to-be investor friends, are on the wrong side of the wealth scale. But the second you pivot your mindset from buying a home to investing in real estate, the entire playing field flips over. Real estate investing is a business. The IRS treats your investment property like a business. That means every single penny you pay in local property taxes isn't a personal loss anymore. It is a direct, fully deductible business expense. The phantom expense is coming. But wait, if you deduct your property taxes against your rental income, you are just reducing the tax on your rent. That still leaves you with paying the actual property tax bill out of your pocket, right? How does that slash your taxes to zero then work? This is where the magic happens. And it's the exact reason why the tax code is secretly a love letter to property owners, just like yourself and me. The IRS gives the real estate investors a superpower that no regular employee or stock market investor ever gets. It's an expense that doesn't require you to spend a single dollar of your actual cash. It's called depreciation. Now, don't let the boring accounting words scare you off. There is zero math required to understand this. Imagine you buy a brand new car. The moment you drive it off the lot, it loses value, isn't it? In real estate, the IRS assumes that the physical building you bought is slowly falling apart and losing value over a 27.5-year timeline if it's a residential building or 39 years if it's a commercial building. Think about how wild that is for a second. In the real world, what happens to a well-located real estate over 20-30 years? It almost goes up in value, but on paper, in eyes of the IRS, your property is decaying into dust like over here. And because the IRS thinks your property is decaying, they hand you over a massive paper-only deduction every single year. A deduction that is often so large, it completely swallows up your rental income, your property taxes, and leaves you with a loss on paper. All the while, your bank account is actually overflowing with real cash. Cool, isn't it? But here is the catch, and there always will be a catch. The big problem most amateur investors face is standard depreciation takes way too long. Waiting 27.5 years to get your tax relief is like waiting for a slow drip coffee when you need an espresso shot of cash right now. So how do the wealthy investors speed this up to wipe out their taxes this year? They use a hyper-accelerated strategy that feels like time travel. Yes, time travel. Section 2, time traveling your tax deductions. If you buy a rental property, standard depreciation forces you to take a tiny equal slice of the deduction every year for nearly 3 decades. That is nice, but it doesn't give you the explosive wealth building leverage today. Enter the wealthy investor's favorite weapon, a cost segregation study. When most people look at a rental house, they see one big asset, a house. But when a specialized tax engineer looks at the house, they see a giant pile of individuals' Lego bricks. They say, wait a minute, the concrete foundation and the wooden frame might last 30 years. But the refrigerator isn't going to last 30 years. The plush bedroom carpet isn't going to last 30 years. The wooden fence in the backyard and the asphalt driveway will definitely need replacing way sooner. A cost segregation study is simply a professional report where the engineers break down your property into different buckets. They pull out the 5-year assets, things like appliances, carpets, specialized lightings. They pull out the 15-year assets, things like fences, sidewalks, landscaping, and the driveway. By unbundling the house into these short-lived pieces, you are legally allowed to drag all those future deductions of depreciation straight into the present day today. And here's why it matters right now more than any other time in recent history. 100% bonus depreciation is permanently back, baby. This means that any asset inside your property that has a lifespan of 20 years or less can be written off in the very first year you own the property. Your tenants paid you mortgage, your property value probably went up, and your bank account is healthy. You have created a paper shield. But Vikram, I have a regular job. I'm a doctor, an engineer, a sales rep, a business owner. I pay massive W-2 or active income taxes, and my property tax is killing me. Can I use the massive real estate paper loss to wipe out my everyday tax bill? The answer is a definite yes. But if you try to do it the standard way, the IRS will block you instantly. There is a strict lock on the door, but there is a secret key that unlocks it perfectly. Let's talk about how to get this key. Section 3. Unlocking the W-2 tax vault. By default, IRS classifies real estate as a passive activity, and the golden rule is that passive losses can only offset passive income. That's why you have the real estate professional status is the key, the magic key. If you or your spouse can qualify as a real estate professional in the eyes of the IRS, that giant wall between passive real estate losses and your active day job income completely dissolves. To qualify, you generally have to spend at least 750 hours a year working in real estate activities, like managing properties, looking for deals, or overseeing renovations, and that time has to represent more than half of your total working hours. That's only 14 hours a week, a piece of cake. By the way, if you are a beginner or an investor and are looking for guidance on how to get started in real estate investing, feel free to book a 20-minute call with me. Link below in the description. Section 4, the 7-day trick that changes everything. This is the ultimate game changer for high-earning professionals who want to completely crush their tax liabilities without quitting their day job. Under the tax code, if you buy a rental property where the average guest stays 7 days or less, the IRS no longer classifies it as standard passive rental property. Instead, they treat it like an active business, just like a boutique hotel or a storefront. Think about what this means. If you buy a beautiful property in a popular vacation spot, a lake house, or a chic condo near a major downtown area, and you rent it out on platforms like Airbnb or Vrbo, your average guest stay is almost going to be less than 7 days. Because it's classified as an active business, you just need to show material participation in running that short-term rental business. If you are the one messaging guests, ordering the supplies, coordinating with the cleaners, and reviewing the listing, you can easily smash through that requirement. Because your average booking is under 7 days and you actively run the listing, that massive 6-figure write-off is considered an active business loss. When tax season rolls around, you take that massive active loss from your real estate investment and you apply it directly against your W-2 salary or business income. The result? You can legally pull yourself down into a significantly lower tax bracket, or in many cases wipe out your federal tax liability entirely for the whole year. The cash savings you get from your regular taxes can easily cover your local property tax bills for the next 10 years combined. Section 5, escaping the tax trap. buy, borrow, die. When you use depreciation to lower your taxes, the IRS keeps a score sheet. Yeah, they say, sure, we will let you write off the value of this property today to save you thousands of dollars. But if you ever sell this property in the future for a profit, we are going to force you to pay back those deductions. What? Force me back to pay back money? No, that's never going to happen. This is known as depreciation recapture, and it is an exact trap that destroys amateur investors who don't plan ahead. They sell their property, celebrate their property by coming to Myrtle Beach, and then get hit with a massive unexpected tax bill from the IRS. But the world's most successful families do not fall into this trap because they use a legendary three-step cycle that allows them to defer, scale, and completely erase those taxes forever. The strategy is simple: buy, borrow, and transfer. I created an old video on generational wealth that you should check it out here. This is what all wealthy investors do. Step 1. Buy and shield. You buy a cash flowing investment property and use cost segregation and bonus depreciation to wipe out your tax liabilities today, just like we discussed earlier. You collect the rental income tax-free because the paper depreciation shields it completely. That's why if you're planning to invest money in real estate, go ahead and book that 20-minute free phone call with me. Link below in the description. We can go over the numbers together. Step 2. Borrow instead of selling. Years later, your property has increased significantly in value. You want to access that wealth to buy a bigger property or fund your future lifestyle. An amateur investor would sell the property, trigger massive capital gain taxes, and face heavy depreciation recaptures. But a seasoned investor goes to the bank and says, hey, I don't want to sell my property. I want to take out a loan against the equity. When you refinance a property or take out an equity line of credit, the bank hands you a massive check of tax-free cash. And why is that tax-free? Because loan proceeds are not considered income by the IRS. And on top of that, your tenant continues to pay down that loan for you. Step 3. The transfer to the next generation. You keep rolling properties into larger investments using another powerful tool called the 1031 exchange, which allows you to defer your taxes indefinitely every time you upgrade your portfolio. You do this your entire life. You accumulate a massive portfolio of real estate, completely shielding your income, paying minimal taxes, and building incredible generational wealth. And then when you eventually pass away, your assets are transferred to your heirs. This is where the ultimate magic trick happens. The step up in basis. When your kids or beneficiaries inherit your real estate portfolio, the IRS completely resets the property values to their current market value on the day you passed away. All those decades of accumulated depreciation recapture taxes, poof, completely erased. All those capital gain taxes from property appreciation over 30 or 40 years, gone. Your heirs inherit a multi-million-dollar real estate machine with a clean slate. They can start the exact same process all over again, taking fresh depreciation deductions on assets that you already wrote off decades prior. This is exactly how America's wealthiest dynasties built and maintain generational wealth without losing half of it to the taxman at every single turn. That's why if you have questions, doubts, concerns, go ahead and book that free 20-minute call with me. Conclusion, the next step. The real estate tax code isn't a secret club meant only for billionaires. It's a set of published instructions open to anyone willing to look past the standard 9-to-5 mindsets. People like you and me, my friends. By shifting your capital into real estate, even starting just with one small property, a simple duplex or a single vacation rental, you stop being the person who gets punished by the tax system and you become the person the tax system is actively trying to incentivize. But remember, the tax code is constantly evolving, so check with your accountant first. Don't forget to hit that subscribe button. Drop a comment below if you're having any questions about the short-term rental trick. And if you think you can retire on real estate income, go ahead and watch my video on the real cost of retiring on rental properties. So until next time, this is Vikram signing off. Good luck, goodbye, and go earn your freedom by slashing your property taxes.